Hey everyone, my name's Andy. My channel is Finding Value. If you like making money, subscribe to the channel. I talk a lot about undervalued assets. Right now, it's mainly commodity driven because that's where the value is. If that sounds really interesting, subscribe. Give me a thumbs up for this content. We're going to talk about potential returns across some sectors. A lot of people like talking about potential returns, and this is my interpretation of history and what the potential returns could be given history. I'm going to show you all that stuff. We're going to do charts. We're going to do all that stuff of a couple different assets. So let's jump into the potential returns presentation, and I'll go over what we're going to look at here. So let's look at price projections. I'm going to look at a couple of assets. So the sectors I'm going to look at are uranium, oil, silver, and platinum. Those are my favorite. These are for fun and are not serious price projections. I do not know for sure where the price will end up. No one does. They're just projections. Two components are what we are looking at here. There's two components. One is gold, which accounts for inflation. The other component is supply-demand balance, which is the ratio compression. And I'm going to show you what the ratios look like. I'm going to talk about what ratio compression looks like. And remember, gold is a moving target. And for this analysis, I just chose a nice round number. Some will say it's aggressive, but I used a gold ultimate peak of $10,000 an ounce. And what that does is it baselines everything. If gold doesn't get to 10,000, if it goes to 5,000, these projections might be cut in half. So it is very reliant on the price of gold because that is our accounting of inflation. And then we also have the supply-demand balance. So first, I'm going to go over uranium. So here's uranium. This is the ratio chart. And I've got the two red circles. So these are price projections, and they're also ways to exit. This is an exit strategy, kind of. I'm not really talking about strategy, but I'm just talking about the ultimate ratio top and where it fell in place with respect to gold. So looking at history, we have a peak here, and this is the peak in the ratio. Now, the peak in price for uranium may be a little bit behind this in the 77, 78, 79 area. But this is where we would be looking to potentially sell, is when we hit these peaks and ratios. And the price may peak a little bit after it, but we're in the general ballpark. That's what's important, is that general ballpark. Now, the way previous bull market in uranium, it compressed from, say, a 22 pounds to 1 ounce ratio down to maybe like a 3 or 4 pounds per 1 ounce ratio. So that is a very good compression, very good leverage to the price of gold in that move. And from here, we went from almost a 50 pounds per 1 ounce all the way down to maybe, I'm going to say, about a 4 or 5 pound per 1 ounce gold ratio. Also, very good leverage. And what I'm going to do is I'm going to take these red circles and overlay them on a price chart of gold, just to show you where the peak of this ratio was in relationship to gold. So if you're looking at gold, I've got one in June 2007 where the price is showing. This would be the most recent circle of $655.49. That's what the gold price was. And then this circle here is the first, is this one right here, projected on the gold price here. So the ratio had peaked a little bit after a good run up. And this one was in the middle of a run up here. So these are where the peaks are at, just to show you, and to show you what the dynamics are going forward. So that was 2007 was a peak, and here you can see the deficits here. We went into a surplus, so that was a definite peak, and this is what's coming up in front of us. So the market balance does look quite a bit different from history. If this is history and this is what we look like going forward, I think the peak is going to be later on, just given this massive deficit in the future. So I do think the dynamics here are a little bit different than history. So the uranium price projection, the way I'm going to calculate this is uranium peaked the last two cycles at around 33% of gold's peak. So if we have a $10,000 gold price peak projection, gold at this time would be about $3,300 an ounce. Uranium's ratio compression, I'm going to say it compresses to about a 5-to-1 ratio. So the uranium price, if we peak at a 33% gold price peak and it compresses to 5, is a $660 per pound projection. The leverage to the current price is about 22x, which is massive, just absolutely massive. So that's kind of what the projections are for the uranium price projection. Now, oil, I'm going to show you oil. I've got the 2008 peak of oil correlates well with an $888 price of gold. So we're going to get the ratio from that. These are the monthly ratios just to show you. Anything under 10 is a very expensive price for oil in relationship to gold. So I've got all these circled and I overlaid those on a price chart for oil. So I did that. These are the peaks here. There's a whole bunch. And some of these, I'll be honest, it would have been very difficult to sell at this peak up here. I probably would have been looking to sell more at this peak because you're throwing a very low ratio here. You turned back up and then the price turned back down. So this one would have been almost a false shakeout here. But looking at this chart, you can see that there was a pattern formed here. You would have been great to have sold right here. And breaking out of this pattern, obviously this is a false breakout here. It would have been early in the game. You're forming this nice chart pattern. So we're breaking to the upside. Here could have been a very good shakeout area for holders. I probably would have been one to be selling some right here. And then it reversed and went even higher. So this one would have been, this is a nice shakeout for a lot of bulls here. So this is the ultimate high. This is, it did show an ultimate bottom right here. So this would have been the move to, if you could have held it all the way. But knowing the chart pattern here, given this pattern, there's a good probability that this breakout, I put the green circles here. These are breakout areas. So we broke out, moving on up. We have another breakout that's occurring right now. And I think it's going to go somewhere way up here to where this line intercepts. And we may touch that line way up there on a blow off top. So that's a possibility. Doesn't mean it will happen, but it's a possibility. And this line is really steep. So the price is going to be pretty high up there. So we do have a breakout. It's looking very good. The price of oil, that doesn't look too bad. Now, here is the world liquids fuel production and consumption balance. This is in million barrels per day. This is implied stock draw or stock build. And we're drawing down on inventory in here. This is implied stock draw. And we've got a little surplus is what they project and kind of an even balance here. Given demand and the forecast, consumption really moving on up with production. Over 100 million barrels a day, probably around 102, 103. That's what the short-term outlook looks like for the next 1.5 years or so, is a forecast of increased demand and also increased production. And I would say a pretty tight, balanced market. So the oil price projection for oil peaked around 45% of gold's price peak last cycle. I'm going to use that as a rough estimate. So if gold goes to $10,000 an ounce, 45% of 10,000. If gold's at $4,500 an ounce, we've got oil compresses to a ratio of 9-to-1. The oil price projected is about $500 a barrel, which is quite high. Leverage to the current price is about 8 times to where it is today. Looking at the gold to silver, so this is the silver price projection that we're looking at. You can see that we've got this massive pattern developing. And what I want to see is this to break to the downside. Maybe it still compresses up a little bit into this corner a little bit more. These are the bottoms here of the ratio. Remember, this is a ratio. So this is a 20 a little bit below 20, a little bit below 20, and this one was a little bit below 40. And those are very low ratios in relationship to history, given these market tops. So I overlaid these ratios and projected them on the silver price. These are the ratio projections of where the tops would be. So pretty good projection here. It gets 100% the move of gold. Silver does. And when it's indexed to gold, that ratio is going to compress and the price is going to go quite substantial. So silver price projections, the ratio peaks at the same time as gold peaks roughly. Gold price reaches $10,000 an ounce. Let's say the silver ratio goes down to 30 to 1. The silver price projection would be $333 an ounce. Now, let's just say it could go to a 10 to 1 ratio. It really could. That's a little bit above what the silver is being pulled out of the ground. And silver price could go to $1,000 an ounce, which is ludicrous. I mean, that's way up there. Leverage is between 10 and 30x. That's my guess. And it is highly dependent on investor demand. Highly dependent. So the investor is going to determine how high this goes and what that peak is going to look like. If investors don't step up and buy this, I think it's going to be more towards the $333 area than the $1,000 per ounce area. Now here's platinum. I'm going to go over a platinum price projection. In history, we've seen some quite large anomalies, over 2.5 even, almost 3, which means it's 1 ounce of platinum can buy 3 ounces of gold. We have a compression of 2, which means 1 ounce of platinum can buy 2 ounces of gold. Right now, we are at a very low valuation, and we're off probably around 0.5 or so. So it's still incredibly cheap. A little bit over 0.5. Maybe it's 0.7 or something like that. This is the platinum to palladium ratio, just showing you the duration here from peak and round to peak. This mimics that same time frame. So these are all the same distance here. And I just threw that in saying, well, maybe this is roughly the distance. If we're at 2020 down here, maybe it'll come all the way back up very quickly. The compression of the ratio, that is, not the price. That's compression of ratio. So platinum price, just to show you, I kind of put some time frames in here. We had a very long bear market, 45 years, where it went kind of sideways the entire time. And I'll show you that in a different clip or a different chart. We've got 3 years up, 19 years down, 9 years up, 12 years down, and then we're breaking to the upside here of this pattern. How long it takes to get all the way up here? Maybe you can draw a line through here, coming all the way up. Maybe it's 3, 4, or 5 grand that we see, but that's what it looks like from this perspective. Probably somewhere between, I don't know, 3 years and 9 years could run. It looks like it is compressing here. It looks like the down years are compressing smaller and the up years are getting longer in duration. So maybe it's a 12-year upcycle or 15-year upcycle. This is a super long-term chart dating back in the late 1800s. And I've got a nice pattern here. And what I'd like to see is this thing to break this upper channel. If it breaks the upper channel, breaks through here, I think it's going to run for a good long time. So looking at these, all of these ratios, the compression, the duration, and this big chart here, I came up with a platinum price projection. So if gold price reaches $8,000 an ounce, that's kind of when platinum reaches a peak. I would say platinum reaches a 2 to 1 ratio to gold. The platinum price projection would be, my guess, somewhere between $3,000 an ounce and $16,000 an ounce. The leverage is between 3 and 15x. And again, this is very highly dependent on investor and industrial demand. And the reason I said 3,000, I said, well, what if this comes all the way back up to the top here? This is probably about 3,500, somewhere in that range, and it were to bounce off this big long-term trend line. that could be a 3,500, something like that. And that's where I got this low end of 3,000, is if it doesn't break out of this pattern here. But if it breaks to the upside, it's gonna go much higher. So the conclusion here, I would not base any investment decisions based off this fund activity. These are just guesses based off past ratios and rough timing. These numbers could vary dramatically based off of inflation, investor sentiment, industrial uses, etc. So this is just for fun. This is not any type of serious price projection. If you look at projections that banks give, they revise it all the time. So these are just based off history. This is kind of what history shows us. I was just throwing in some numbers, throwing in some durations and time frames, trying to say, hey, look, this is kind of what it might be. This is kind of the time frame. Even though I didn't really give too many time frame projections, I just kind of wanted to see what the charts showed us, what the ratios are at, what the ratios tell us, and then put numbers to it. I think of physical metal, I do think platinum and silver are the best bets. Those two I think are pretty good. And I think uranium and oil are highly leveraged to inflation, highly leveraged to gold. And I think those are some pretty good bets as well. So I like every single one of these opportunities here. I don't know if you can do the same type of analysis with copper and these other ones. I mean, we could, but the demand for those are ludicrous amounts more than I think what history, given history. History has been kind of the natural growth of copper. But if we're going to try to put in these renewables, I mean, we're going to blow through copper like it's nothing. So I would suspect that copper would be a much stronger price environment than we've had in the past, given the commodity bull markets. If you guys like this content, give me a thumbs up, subscribe to the channel, leave some comments. Do you agree with these price projections? What are your price projections? Put them in the comment section. I want to hear what your price projections are for uranium, oil, platinum, silver, or whatever ones you're interested in. Throw them in the comments section. Love to hear your guys' opinion. Thanks for listening. This is Finding Value.